Good evening, girls. Cost accounting. Okay, this is cost accounting, marginal costing, and cost volume profit analysis. So I already discussed about absorption costing the other day, isn't it? Now we have to learn about how profit is ascertained under absorption costing. For ascertaining profit under absorption costing, the following proforma is used for ascertainment of profit. How is an income statement prepared under absorption costing? First of all, you will record the sales. From sales, you will deduct what? Cost of goods manufactured, such as direct material, direct labor, factory overheads. Because when I talk about the various expenses, we know that absorption costing records both fixed expenses and variable expenses. So direct materials, cost of direct labor, factory overheads, variable factory overheads, fixed factory overheads, all will be taken into consideration under cost of goods manufactured, and it will be deducted from sales. After we get a value from sales minus cost of goods sold, whatever value we get, with that we add the value of opening stock. Any opening stock will be added. Deduct value of closing stock at current cost. Then whatever value we get, on that we add under absorption, or we deduct over absorption of any fixed overheads. Then you will get gross profit. From gross profit, you will deduct administration, selling and distribution expenses. That is both fixed and variable. In case of marginal costing, we take only variable cost. But in case of absorption costing, we are taking both fixed and variable expenses to arrive at net profit, net income, or profit for the firm or the company. Okay. So now when I solve a problem, I think you'll find it very easy. Okay. So once I will solve a problem under absorption costing, you'll find it very easy. See, this is the problem. Okay. This problem later, don't worry now. I will send you the picture later. Okay, of the entire problem along with the solution. Try to understand the problem here. I'm trying to explain the problem. What is explained in the problem? Your company has a production capacity of 2 lakh units per year. So the production capacity of the company is 2 lakhs units per year. That means up to 2 lakh units only the company can produce units in a year. Normal capacity is what? 90%. Standard variable production costs are rupees 11 per unit. Fixed factory costs 3,60,000 per year. Variable selling costs rupees 3 per unit, and fixed selling costs rupees 2,70,000 per year. Unit selling price is rupees 20. In the year ended 30th June 2016, the production was 1,60,000 units and the sales were 1,50,000 units. The closing inventory on 30th of June 2016 was 20,000 units. An actual production cost for the year rupees 35,000 higher than the standard. Calculate profit for the year under absorption costing method and under marginal costing method, and explain the difference in the profits as well. Okay, so this is the profit statement. So I will begin, okay, giving you the solution of a particular problem. So how do we calculate? How do we do the calculation now? So you understood the problem now. First, I have already explained. I read out the problem to you all. Okay. First, as I have read out the problem to you all, now I will show you how to go for calculation of profit under absorption costing. So first of all, you will write absorption costing. So under absorption costing, you will write ascertainment of profit. So ascertainment of profit, or you can prepare the income statement. Okay, ascertainment of profit under absorption costing, that is the income statement under absorption costing. So first of all, what are you supposed to take? We are supposed to take sales as per the format. I think you know in the format is given sales. So what about sales? Sales, they said sales is production capacity is 2 lakh. Units produced is 2 lakh, but sales is not given here, isn't it? Sales is given later. The given selling price per unit is rupees 20. Okay, in the production, sales were 1 lakh. See, sales were 1,50,000 units. Unit selling price is 20, and in the year ending June 2016, production was 1,60,000, and out of the product units produced, so units sold was 1,50,000 units. So what will you take? You will take sales is 1,50,000 units, isn't it? 1,50,000 units multiply by 20 rupees, isn't it? Unit price is 20. So when you multiply, you will get 30 lakhs. Okay, you will show 30 lakhs in the outer column. Straight away, you will show it in the outer column. From sales, what will you do? You will deduct cost of production, isn't it? What are the things you'll deduct from sales? You'll deduct cost of production, cost of goods manufactured as per the format, isn't it? As per the format, what are you supposed to take into consideration? Cost of goods manufactured or cost of production. Goods manufactured or production is the same. So what are the things you'll take? You'll take variable, isn't it? Under this, what are the things you'll take? You'll take variable production costs. Now first, what are you supposed to take? You will take variable production costs. So how much is variable production costs? Units produced is how much in the year to year ending June 30th 2016? Total units produced 160, isn't it? 1,60,000 multiply by 11. See, standard variable costs are rupees 11 per unit, isn't it? Variable costs. So variable production costs. So 1,60,000 units into 11, isn't it? It will become what? 1,60,000 units multiplied by 11, isn't it? Will be the variable production cost. So you are getting how much? 17,60,000. Okay. Next, what will you take? You will take fixed costs. Next, what will you take? Fixed costs. Because absorption costing records both fixed and variable costs, isn't it? So what will be your fixed costs? Fixed costs will be 1,60,000 units produced multiply by 2. How we got 2, I will show you. Okay. Fixed cost during the year is how much? Fixed factory cost during the year is 3,60,000. And how many units are produced? 1,60,000 units. How many units are sold? So on the basis of that, you can just divide, okay, and find out that it is 2. Okay, fixed cost is at the rate. Fixed cost for 1,60,000 units will be at the rate of rupees 2. You will get 3,20,000, and you will also find increase in variable cost. See, what is your increase in variable cost? The actual variable over production cost increased by 35,000, was higher than the standard. So that means what? There is an increase of 35,000. So increase in variable cost, you will write 35,000. I will show you rupees 2, how to calculate rupees 2 later. Okay, as for now, you write rupees 2. Okay, it will come to 3,20,000. So together you will get 21,15,000. From there, what will you do? You will add opening stock. How much is your opening stock? Is given in the question. Opening stock is, closing stock was 20,000 units. So opening stock will be what? See, closing stock is given 20,000 units. Opening stock will become 10,000 units. For example, sales plus closing stock, isn't it? Minus production, you will get opening stock. This is the formula of calculating opening stock. From sales, total sales is what? We already know that cost of goods sold is equal to opening stock plus purchases minus closing stock. We know closing stock. We know production during the year. We know we do have to calculate opening stock when we know cost of goods sold. So it will be easier. So how much is sales? Sales in units is how much? 1,50,000 units plus closing stock. So 1,50,000 plus closing stock is how much? 20,000. So 1,50,000 units plus closing stock 20,000, 1,70,000 units. Minus how many units produced? 1,60,000 units. So opening stock will become 10,000. So opening stock, how to calculate opening stock? Opening stock will be equal to 1,50,000 plus closing stock 20,000 minus units produced. How much? 1,60,000. So when you add this two, you are getting 1,70,000 minus 1,60,000 will be your opening stock. So opening stock is 10,000. Okay. So opening stock. So when opening stock is 10,000, then you are supposed, what are you supposed to find out next? Fixed costs. Fixed costs at normal capitalization unit utilization. So how much will be your fixed cost at normal capitalization capacity utilization? So it will be fixed cost during the year. You have to take the total fixed cost during the year, that is 3,60,000 per year. So you're taking 3,60,000 per year divided by normal capacity utilization is 90%, isn't it? What is your normal capacity? 90%. So it will become 90% of 2 lakhs. Why 2 lakhs? Because 2 lakhs is the production capacity. Production capacity is 2 lakhs per year. And normal capacity is 90%. So it will become 90% of 2 lakhs. So 90% of 2 lakhs, you calculate, then divide by 3,60,000. Okay, then you will get 1,30,000. That is your opening stock, the cost of opening stock. Less closing stock. Closing stock is 20,000 units, isn't it? So how much will be the value of closing stock? For 1 lakh, see, for 1 lakh, for 1,60,000 units, the cost of production is how much? For 1,60,000 units, you're getting 21,15,000, isn't it? Therefore, for 20,000 units, what will be the calculation? It will be 21,15,000 divided by 1,60,000, because production is 1,60,000, isn't it? For 1,60,000, total cost is how much? 21,15,000. So for 20,000, how much will it be? It will be 21,15,000 divided by 1,60,000 into 20,000, so that you get 2,64,375. That will be the value of closing stock, which you have to deduct. After you deduct, you are getting a figure that is 19,80,625. From there, what do? You add under absorption of overheads, fixed costs. Why there is an under absorption of fixed costs? Fixed costs, what is mentioned in the question, fixed cost is 3,60,000, isn't it? Then you have fixed costs. There are two fixed costs given, isn't it? One is fixed 2,70,000 selling fixed selling cost, 2,70,000.